Welcome back for another video. This is a continuation of the psychology and mindset section of the mentorship. And in today's video, we're going to be talking about the importance of a mental framework. So welcome back to part 2. Now, before I proceed, there is a question that I would like to ask you. And that is, do you want to become a high stakes trader? Have you really got what it takes to trade a 7 or 8 figure account right now from tomorrow? How would you feel trading a 7-8 figure account? I would argue that you can do it. If you want to become a 7 or 8 figure trader, you can do it. Genuinely, you can do it. If others can, why can't you? What's stopping you? It's not about the market. It's not the strategies. It's not even about the economy. It's you, your mindset, your approach, your lack of self-awareness. It's your failure to understand that your emotions are wreaking havoc on your trading. How often do you trade and you experience these emotions such as fear, greed, impatience, but you're not aware of them? You think you've got control of them, but they're silently guiding your decisions and dictating your outcomes. So the truth is, until you address your emotions, your success will always be limited. If you're not ready to trade a 7-8 figure account, then you know exactly why. Because you're not in that right mind frame. You don't have the right process. You don't have the right experience. You don't have any edge or statistics to prove that you are at that level where you can go ahead and trade 7-8 figures if somebody gave you that responsibility to trade that account. So it's time to take control of your mind, understand your emotional triggers, and start trading from a place where you have a level of clarity, discipline, resilience. If you can master your mental game up here in your brain, then I'm fairly certain that the success of your process, your strategy, and eventually the financial success will follow. So what is a trading mental framework and its importance? A trading mental framework is a structured approach to managing the psychological and emotional aspects of trading. It's a set of principles, strategies, and practices which are designed to help traders develop the necessary mindset needed to handle the inevitable ups and downs of the market. In trading, success is not just about your strategy or analysis. You can become, like I said before, a really proficient technical master when it comes to price action trading, but it's irrelevant because the underlying foundations for success is not just about your technical skill set. I'd argue it's probably 20% in terms of contribution towards your success, but it's about mastering your mind. And therefore, a strong mental framework allows you to stay focused, disciplined, resilient, in the face of challenges, and so that you're reducing the impact of emotional biases. And those emotional biases, when you experience them, that's what causes you bad decision making. Now, the importance of a trading mental framework cannot be overstated. Without a clear mental structure, traders can easily fall apart to their emotional pulses like fear, greed, overconfidence. All of these that I've just mentioned lead to significant losses, or they can lead to significant losses. So a mental framework really helps you remain grounded, process-driven, ensuring that your decisions are based upon logic, a set of guidelines, and helps you achieve a level of consistency. And therefore, by creating and maintaining a solid trading mental framework, it helps you become better equipped to deal with the unpredictability of the markets and significantly improve your chances of long-term success. Understanding markets. As traders, we need to accept a fundamental truth, and that is we can't control what markets do. But what we can do is understand them. Now, many traders, especially beginners, fall into the trap of trying to predict every market move. But the reality is markets are unpredictable, and no amount of analysis will ever provide absolute certainty. Why is that? Well, because anything can happen at any time. Global events like wars, unexpected economic policy changes, even a single major news announcement can shift the markets instantly. How many times have we traded a crypto market where there's been a cascading liquidation event? For those of you who were around in 2022, with the collapse of Luna, caused a significant cascade in the crypto market, especially with the implosion of FTX. And therefore, liquidation events are where traders are forced out of their positions. Cascading liquidations that create a domino effect, or even external shocks like exchange hacks that can shake investor confidence. These all have an impact on price. And even over in the FX world, you have central bank policy changes such as interest rate decisions. These can drastically alter the market landscape. So instead of focusing on prediction, we should really focus our minds or shift our mindset towards adaptability. So what's the key to understanding markets? And that is embracing uncertainty. Even with the best analysis or setup, that can be disrupted by unexpected events. Market moves are unpredictable with a high degree of randomness. So you have to stay humble, open-minded, be aware, and avoid speaking in absolutes. Because it really doesn't matter how good your analysis is or how perfect your trade setup looks. Markets are unpredictable, and there's always a high degree of randomness in market movements, which means that no prediction is ever likely to be 100% right. Hence, why having a rigid expectation can be very, very dangerous for traders. So to navigate this, really you need to be thinking about embracing an open mindset, staying humble, adaptable, avoid speaking in absolutes, because the more flexible you are in your thinking, the better you'll become at managing risk and making sound trading decisions. Because if you're not, the market will not give a fuck about your positions. The market doesn't even care about you. But what you can do is understand and be respectful towards the market. So not only do you need to embrace uncertainty, you need to be aware of randomness. Because how many times do you see traders on Twitter talk about, I don't think Bitcoin's going to go below 70k ever again. I don't think Bitcoin is going to give that pullback. I think Bitcoin's going to go to 150, 160. And then what happens? The markets crash. It clearly happened in 2021 when Bitcoin was at 60k. This perception of Bitcoin now going to 70, 80, 90 was fairly high. It was fairly accepted. But it's a prediction. And many were not prepared for what happened in April or May of 2021 when the markets crashed. Bitcoin went from 60k back down to 30k in a matter of 2.5 weeks. So many traders struggle because they don't fully appreciate or accept uncertainty. And that leads to stress, frustration, and poor decision making, right? Which then makes you question yourself as a trader. Common emotional reactions to not embracing randomness is, did I make a bad analysis? Is the market rigged? The market's manipulated. The algos are out to stop me. It's a PvP environment. Bullshit. These are all excuses simply because of the fact that you're not able to think objectively about price, objectively about the markets. So the three key aspects that I've highlighted here is, number one, accepting uncertainty reduces stress, fear, and emotional attachment. Number two, staying objective allows you to see the market clearly and without bias. Point number three, the market isn't personal. It simply moves. And your job is to respond, not predict the market. So if you want to develop as a trader, you really need to start thinking objectively first and foremost, and embracing this mindset, embracing uncertainty, embracing randomness. Two key words, uncertainty and randomness, and embracing them both. Now, before we move on to the next slide, I want to ask you a very simple question. What is trading? What does it mean to you? In a nutshell, what is trading? Have a think about that question before we move on to the next slide. How would you define trading? The truth about trading is it comes down to expectancy. And so what you're really looking for is positive expectancy. Remember this because we will come back to this in an example later on in this video. And I'll demonstrate how it's not about your win rate. It's about how big your winners are and how small your losses are. You can have a 30-40% win rate in trading. In fact, some of the best traders in the world have a 35-40% win rate. But why are they successful? Well, because their average winners exceed their average losses significantly because their losses are very, very small. On the flip side, when you look at some of the CFD brokers, traders who trade on CFD platforms have anywhere between a 60 to 65% win rate. Yet they're not profitable, yet they have a negative expectancy. Why do you think that is? It's simply because of the fact that their average loss size exceeds their average win size. So win rate and loss rate alone don't really count for a great deal. Doesn't matter if you are on a 20 winning trade streak. What's the average size of those wins? What's the expectancy overall of your strategy? That's what matters the most. So to measure success in trading comes down to expectancy. So expectancy. This slide just summarizes everything we've discussed about the importance of having a positive expectancy. You want to be successful in this game, you've got to have a positive expectancy. How many of you out there right now know your expectancy for the last 12 months? If you don't know your expectancy, what are you doing in this game? And if you're not tracking your expectancy, it's time to wake up. So you want to be tracking your risk-to-reward ratio. You want to make sure that your losses are small and your average wins far exceed your losses. And then we come into the compounding effect, where larger wins help to build your trading capital more effectively with fewer winning trades. Your strategy should be able to survive 3, 4, 5 losses in a row because the focus is more upon capturing the larger moves when they happen. Okay, you only need a good few trades in a month to outperform all those losses, and therefore you can have a very low win rate. Mine's hovering around 46-47%. That's because I've got a nuance to my system, which is a 3-strike rule on trade execution. I will take very, very small cuts before I can get into my desired position, and I believe that the probability is in my favor. And guess what? When the move happens, my average win size exceeds my average loss size because I take very, very, very small losses. In fact, risk management and taking small losses is one of my strengths. It's what's allowed me to survive in this game and build and compound my own account over the years. I've been trading for 9 years now, of which the last 5 years have been profitable. This image was taken from the book, Mastering the Mental Game of Trading. Look at the number of wins and look at the size of the wins. Look at the magnitude of the letters of the wins, right? You can see more L's on this diagram, but yet there's probably 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 wins and far significant more losses. And this is an example of positive expectancy. So don't beat yourself down if you're constantly losing trades. What it really comes down to is how much you lose on those trades. If you can stop the rot and stop the bleed and stop pissing money away on your losses, you're halfway there to becoming a good trader. Because the number one reason why people blow up is because they take those big, significant losses. And when it comes to winning trades, they fuck up. They can't capture the big wins. Now let's take a step forward. When you see a diagram like this, how do you envisage the P&L curve to look like? Any ideas? Any guesses? Pause the video. Have a think about what the P&L chart would look like for these stats. You'll be surprised to see it's a lot of sideways, a big spike up, significant sideways, another move up, slow sideways again, another move up. This is what positive expectancy looks like. Look at the control of the risk management. Look at the control of the account drawdown. So again, look at this. Consecutive losses, right? By the decline in the graph. But it's a very, very slow decline, which demonstrates fantastic risk management and the ability to lose very small amounts. But yet, when those big wins happen, look at the significance of what happens to the P&L. So trading with positive expectancy entails trading with high risk to reward setups. I personally aim for at least 2R, sometimes 3R, maybe more if it's a range trade. I can easily chalk up a 4R trade when the setup is there. And so profits really depend upon identifying occasional opportunities for aggressive risk taking. We'll talk about risk taking and position sizing in the module that we'll cover under risk management. Right, so I hope you've had a good understanding of the importance of number 1, expectancy, 2, why we need to have a positive expectancy. Now let's talk about expectancy and managing the psychological toll. To manage the psychological toll, it requires you to have a bargain with yourself to stay committed during challenging periods. There will be dry periods in trading where you go through loss after loss after loss. Sometimes I've been on 4 or 5 losing streaks. It involves accepting periods of losses, underperformance, erratic returns, and P&L volatility in exchange for potential long-term gains. You have to go through this. Don't think that you can watch some videos such as this and other videos and that's it, you've mastered the art of trading. It's a gradual learning process, and we'll talk about this when it comes to developing a mental framework. But before we can develop a mental framework, I need you to understand the importance of everything we've just covered in today's video. Understanding markets through to embracing uncertainty, embracing randomness, being able to think objectively, understanding the truth about trading. What is trading? Taking everything away, ultimately what is trading is expectancy. So then you have to understand why positive expectancy is important, what that may look like, and why you can have a low win rate, but your percentage of wins far exceeds your losses. And what that might look like on a P&L curve. You'll see periods of sideways and grind and chop, and then you'll get a spike up. Okay? What you don't want to see is periods of sideways and then a massive significant drop down where you've just erased 30, 40, 50% of your account in one trade. Those type of events will emotionally destroy you, and it'll destroy your trading career, because this game is all about survival. You have to survive, okay? So there's really no reasons to be taking these big losses. As of today, there's absolutely no reason on your futures account to be taking any significant losses. Put a stop to it from today onwards. And so the emphasis on skillful use of risk and capital to optimize the upside while carefully managing drawdowns and avoiding overexposure. But it's important that you now start being more self-aware of the emotions that you're going through, because you keep hitting a losing trade, then another one and another one. So don't fall into the trap where the next trade setup, I'm a bit hesitant, I'm a bit scared, or I'm fearful, or perhaps you're going to start revenge trading and think, you know what, fuck this, I'm just going to double up on my trade size here and let me just floor this next setup. I really need to get that count back to break even, or back to where it was last week. And before you know it, like I said in the previous video, you're 4K underwater, you've gone for the jugular, and now you're 8K underwater. Your account has just suffered a 10% drawdown in a week. You have a few more weeks like that. your account will be down to 30-40%. And then it's an uphill struggle thereafter. So ultimately, this comes to self-recognition versus true control. Now, just because I've mentioned the fact that you have to be aware, being aware doesn't necessarily equate to control, because recognizing your emotions in real time doesn't mean that you can stop them, as emotional patterns have very, very strong momentum. And so you get this perception of false control. You know, initially, you may recognize that you have a level of control, that you're fearful at a level, or that this urge to revenge trade, no, I'm curving it back in, I've got a control of it. But it's temporary, and it's driven by novelty, not real correction. It's because over the last 2-3 days, you've been thinking about your trading, you've been thinking about not revenge trading, you've been thinking about not active impulsively. But the minute you stop thinking about who you are as a trader, you will go back to your old habits, because you've not really addressed the root issue or the root cause. And so most traders need more than recognition or self-recognition. And therefore, true change requires more than just mapping your emotions. Deeper performance flaws need to be addressed in order to see yourself progress as the trader that you aspire to be. To achieve that sustainable level of control in being able to work with your emotions, it requires a much greater, deeper level of work, right? Equally, if not more, than all the effort and time that you've put into learning the technicals of trading, of price action, of whatever system you've adopted, you need at least that much effort, if not more, on the mental side of trading, on the emotional side of trading, understanding yourself, who you are. 80% of your trading success comes down to your emotions, managing your emotions, working with them, being self-aware of them. Okay, it's not easy, but it can be done. And so that leads me on to the next slide. How do I progress forward? So we'll take a pause here, and we will have part 3 coming out shortly after this video. But I just want you to appreciate everything that we've discussed over the last 2 videos, from understanding the weaknesses of a trader, understanding some of the common problems that we have. I talked about emotions, why emotions play a big part in trading. And then today we looked at understanding what markets are, what it really means to be a trader, and what you're looking for as a trader, which is expectancy, and having a level of appreciation for expectancy and a positive expectancy, and what that really means moving forward. And this is the end of part 2. Thank you for tuning in.